Hi, my name is Christopher Terry, CEO of iMarkets Live, and in this video, we are going to discuss lot sizes and contracts. What we're going to do is we're going to show two charts. One is going to be Forex, actually three charts. One is going to be Forex spot, another can be Forex futures, and another is going to be the S&P futures. And then we're going to write down a little bit of detail on how this all works. So the first one we're going to look at is the Forex spot market. The Forex spot market has three types of sizes. They're called lot sizes. The first lot size is the micro. The next size is the mini, and the large size is the standard contract. When we are talking about futures, for instance, the Forex futures, we look at contract sizes. These are futures contracts, and they expire every several months. The same thing goes with the S&P E-mini futures, and as we see here, these are also contract sizes. So we're going to be referencing back and forth between our little whiteboard and our charts to discuss these particular markets. So let's put this back on the EUR USD. Let's throw up our whiteboard and start discussing them. Okay, first we have the Forex spot let's just call it Forex spot. Okay, the Forex spot market is traded in lot sizes, lot sizes. The first one is the micro. Now we spoke about this in another video, but we're going to review it again. Micro lot. The micro lot, we are looking at roughly $1,000. Okay. The size is $1,000. Now, as we discussed before in a prior video, or in another video, the lot size is one thing, the margin is another. The margin, as you recall, is around 20 bucks, and the leverage is 50 times, and that gives you the $1,000. So it's $1,000 times the contract or the size. So let's just say it's 1.22 for argument's sake. Okay, so you are leveraging $122,000. Oh, I'm sorry, 1,220 bucks. So for $20, we are leveraging 1,000 units of the EUR USD as we're showing, times $1.22 is 1,200 bucks. The next size is the mini, and this is based on 10,000 units. When it's not the USD in the front, as we discussed, like the USD JPY or USD CAD, it's then based on the price of the market. So we're basing it, say, on the EUR USD. And we discussed that around 200 bucks, 300 bucks would be your margin, but you're dealing with 10,000 units. So at the rate of what the currency price is, you are dealing with, okay, $12,000. And then the third one is the standard contract. This is what the big players trade with, those with decent sized money in the account, and it's $100,000 or 100,000 units based on the currency. So on the EUR USD, based on the video, you would be looking at $122,000 to control 100,000 units. And as we spoke earlier, if it's the US dollar pair, it's 2,000. If it's a dominant with the EUR USD, this would be around 3,000 or so. So you're controlling 100,000 units. So this is lot sizes. In the Forex spot market, you got three sizes: micro, mini, and standard. However, in the futures market, it's different. The futures market, we have only a standard contract in the Forex market. You have, for instance, the 6E, which is the EUR-USD, and we are looking at roughly 100,000 EUR-USD times the rate, which is $1.22, and it's 122,000. Okay, and that is how this works here. The margin, as we spoke about, was $500 to day trade it, and you're leveraging hundreds and hundreds, a couple of hundred times the money. So this is a contract. Now the thing with the Forex spot market is it's continuously 24 hours a day, 5 days a week, 365 days a year, or 52 weeks a year. The futures market has contracts, and each contract expires and goes for 4 months. So the only difference is that prices will fluctuate and change. For instance, you have December contract, you have a March contract, you have a June contract, and a September contract. So the price would be in December would be 1 point, whatever it may be. The March contract, as it gets closer to the date, they do what's called a rollover, where the December would expire and everybody trades into the March contract. And in the beginning, there's a big difference in these prices, but as the dates get closer to what we call a rollover, an expiration, the prices actually become the same and goes into the next contract. So they become really close. The only thing you have to concern yourself with every 3 months, every couple of months, is they change contracts, and that's it. You really don't have to do much other than making a little change on your platform. And I'm actually going to show you what it's like. So it's not something you should be intimidated by at all. Okay, let me just get this going here like this. This is how hard it is. So for instance, on NinjaTrader, we have the March contract. If we wanted to look at the June contract, we would just do this. If I could find here it is. We'd find the June contract, and you put it over. That's the extent of how hard it would be to change contracts. So not a big deal. But in the futures world, that's what happens. The same thing in the S&P futures. You have the same thing. You have contracts which go from month to month to month. And as we said earlier, they're contracts, and it's the same with the pricing. The pricing is you're leveraging $500 in margin, you're leveraging $100,000 roughly to trade this market. It's 50 times the value of the market. So if we come here and you just want to watch this video again, if you get a little confused, it's very simple. The value of the market here is, say, 2060, so just say 2000. So the value of the market is 2000. So the contract side is 50 times 2000 is 100,000, and that's it. We trade it, it's 500 bucks. Contracts, futures are traded in contracts. The spot market's traded in lot sizes. Essentially, it's all the same. It's just semantics, but I did want to explain a little bit of what exactly it means, and that way it clarifies or gives you the proper detail. All right. And in the end, we really care. We just want to buy and sell and make money. Anyway, in the next video, we are going to discuss what is a trend and what is a range. And that's in a great video.